Cryptocurrencies are viewed as assets by the IRS, and they trigger tax events when used for payment or cashed in. With centralized exchanges enforcing KYC rules and sharing customer data with the IRS, it's harder than ever to avoid crypto taxes. Sales proceeds minus cost basis is the formula for capital gains or losses, and this information must be reported on Form 8949. 1. Know your customer, KYC. Know your customer, KYC, is the name of the set of guidelines and regulations that financial institutions follow to verify a potential or current customer's identity, suitability, and risk. These rules are a part of the larger anti-money laundering, AML, and counter-terrorism financing, CTF, frameworks. The KYC process is vital in the banking and finance industries to combat criminal activity like money laundering and terrorism financing. Moreover, the rules help ensure that financial transactions are legitimate and safeguards that the integrity of the entire financial system is not compromised. When it comes to crypto tax, it is important to keep in mind that the IRS treats digital assets as property rather than currency for tax purposes. That means that when you sell your crypto for a profit, you will be required to pay capital gains taxes. However, if you sell your crypto at a loss, then you may be able to take a deduction for the loss on your tax return. Whether you are a buy and hold crypto investor or a day trader, it is important to document all of your crypto sales and purchases. This includes records of your crypto wallet addresses, transaction IDs, and exchanges. It is also a good idea to record the date and price you sold your crypto. This will be helpful if you are ever subject to an IRS audit. It's also a good idea to keep records of all your crypto-related expenses, including trading fees and storage costs. Finally, if you lose your crypto to theft or casualty, make sure to document that as well. It is possible that this could count as a capital loss on your taxes, depending on your state's rules. 2. Know your transactions, KYT. The Bank Secrecy Act, BSA, requires that anyone who engages in trade or business in the United States must collect information about all cash transactions over $10,000 and report them to the IRS, with some exceptions, like gifts. Cryptocurrency, on the other hand, is pseudonymous, meaning it can be difficult for regulated entities to meet this requirement. KYT is a solution for this problem, as it allows financial institutions to monitor cryptocurrency transactions and flag suspicious activities, helping them to stay in compliance with the law and avoid fines or reputational damage. Aside from preventing money laundering, KYT can also help businesses maintain integrity and build trust with customers and investors. It is important for businesses to have a thorough and effective KYT system in place, especially as the use of blockchain technology increases. This is because the decentralization of blockchain transactions makes it challenging for centralized exchanges to monitor and control them effectively. KYT allows regulated entities to keep an eye on crypto transactions in real time and identify red flags such as unusually high sums of assets transferred, or connections to sanctioned individuals or countries. The best way to ensure that your KYT system is effective is to ensure that it has the right data. This is because KYT relies on a thorough record of each transaction, and inaccurate or incomplete data can lead to false alerts and ineffective monitoring. To avoid this, you must have a database that is constantly updated with the most recent and accurate information. It is also a good idea to train your employees on the basics of the system and how to identify and flag anomalous activities. 3. Know your assets, HODLer. Whether you're selling your cryptocurrency for USD or other government-issued currency, or using it to buy goods or services at crypto casinos or stores, you are required to report all gains and losses on your tax return. Cashing out or spending your crypto, even if you only made a small profit, is a taxable event and will result in capital gains tax. In contrast, reporting a loss on your taxes can significantly reduce your liability in the current year and even in future years, thanks to an IRS strategy called tax loss harvesting. To determine the amount of your tax liability, you must know your cost basis for each individual cryptocurrency you hold. The best way to do this is by reviewing your records from when you purchased the asset, or in many cases the exchange will provide you with an official statement of your cost basis at the time of sale. In most cases, a taxpayer's total cost basis will be determined by subtracting the sell price from the purchase price and adding any applicable fees. If you're a staker, determining your cost basis is more complicated than simply identifying the market price at the time of receipt because the IRS requires that staking rewards be reported when they are received, not when they are sold or disposed of. The IRS also uses blockchain analysis to trace your crypto transactions, so you'll likely receive 1099 MISC, 1099-B, or Forms 1098 from your exchanges at the end of each year if you have a substantial amount of trading activity. Luckily, Gordon Law Group offers advanced troubleshooting for most crypto tax software, and we're happy to help you avoid common errors that can lead to costly IRS penalties. 4. Know your income, KYI. As cryptocurrency evolves into more of an investment than cash, it's important to be aware of how this will affect your tax situation. The IRS classifies crypto as property rather than currency, meaning it can be subject to either income or capital gains taxes based on the type of transaction you are making with your digital assets. The key is understanding how your crypto is tracked and reported. The most common triggers for crypto taxation are selling or spending your digital asset at a profit. When you sell, the IRS will look at your original cost basis, your purchase price plus any fees, and subtract that from your sale price to find your taxable profit. You will also need to keep track of your spending and mining activities. This can help you claim theft and casualty losses on crypto investments if you have them. You may also be able to offset these losses against your capital gains in the same year. The tax landscape for cryptocurrencies is constantly changing. This means that traders and investors need to stay updated on new policies and regulations. It's also helpful to work with a licensed tax professional that can provide guidance and advice for specific crypto transactions. Coinly helps simplify crypto taxes by tracking your unrealized gains and losses in a simple, intuitive interface. We also calculate your taxable crypto gains and losses for you, including your cost basis, profits, income, and expenses. We can even use different cost basis methods like FIFO, LIFO, or HIFO so you can optimize your crypto tax position. Learn more about Coinly for crypto taxes here. 5. Know your options, KEO. Cryptocurrencies are taxed much like property, with realized capital gains or losses determining your tax liability. While some crypto transactions have no tax impact, others may require reporting to the IRS. The cryptocurrency tax landscape is rapidly evolving, with both regulatory agencies and cryptocurrency participants constantly changing their positions on how the space should be treated. As such, it is essential for tax professionals to keep up with the latest developments. This can be done by subscribing to news sources that focus on crypto taxation, reviewing official regulatory announcements, and attending webinars and conferences for crypto tax professionals. When you receive new crypto tokens from an airdrop or hard fork, you must report this as income. The tax burden is based on the fair market value of these assets at the time they are received, and will be reported in USD. Similarly, if you receive crypto as part of a reward for mining or staking, these funds must be recorded as taxable income. The fair market value of these assets at the time you receive them will be used to determine your cost basis for tax purposes. You will also need to record any cryptocurrency that you have given as a gift, or sold for fiat currency. For this reason, it is important to track your costs and dates for each purchase or sale. This will allow you to accurately calculate your tax liability if you decide to sell in the future. If you donate crypto, you could receive a charitable deduction based on the fair market value of the asset at the time it is donated. In the future, it is possible that businesses viewed as crypto brokers will be required to issue 1099-DA forms to both users and the IRS.